Vincent, today Diageo reported a pretty good set of results. How are they looking?
Well, I think they're looking reasonably well, actually. The sales were up about 6% globally, but some of their brands are really powering ahead. I mean, Johnnie Walker, for example, is up 15% in organic sales growth around the world. They're doing very well. You know, they're very well spread geographically, so they seem to have a very good platform from which to grow from here.
But who are Diageo? I mean, they have so many brands, it's really hard to keep up with what kind of a company they are. I mean, are they a beer group? Are they a specialist alcohol group? It's quite confusing for people looking at the company.
I mean, they're generally described as the world's biggest drinks company, and that is essentially what they are. And it's primarily spirits, so 80% spirits, 20% beer, and including Guinness, of course, which was because the original Guinness is part of Diageo now. But they have premium brands, essentially. Scotch, vodka, gin, all that kind of thing. Their brands tend to be premium. They have a lot of brands, but they tend to be premium brands. So they are, the sort of top sellers at the sort of high price points in a lot of the markets that they're in. And I think that that's why, they can consistently report increases in sales, and that's why they have generated so much cash, for example, as well. That's another one of their strong points.
Okay, but then how does that affect their pricing? I mean, because when you're looking at comparing them with other companies, you were saying earlier that Pernod Ricard is doing better on a pricing perspective. So, I mean, how do investors take Diageo then when they've got this sort of mixed portfolio of drinks?
Well, I think that Diageo has had trouble convincing investors of the stable of products that it had, and that it was sort of getting the most out of all of them. And I think that what it has done in the last 12 months is that it has set some targets that it didn't used to do. Right. And the CEO last year sort of set the target of 6% compound annual growth rate for sales, and wanted to raise margins by 200 basis points by 2014. And they'll have 50% of sales coming out of emerging markets by 2015. They're on course to meet all of those.
Okay.
So so I think that there's more visibility about Diageo now than there used to be, and I think that's helping the share price. It has tended to lag behind the sector over a sort of long-term period, but it seems to be sort of losing that tag of underperformance now. It's doing very well this year, for example.
Okay, so beyond emerging markets then, I mean, what else does the company need to do?
Well, I think the one sort of big outstanding thing it has to do is to sort out its relationship with Jose Cuervo, this tequila maker in Mexico, which it distributes. But the distribution agreement expires next year. It's a very valuable brand, and I think that Diageo would like to keep that. And it's a question of, does it have to buy some of it, or how does it go from here, because it'll need to have that sorted out by next year.
So overall, Diageo, the biggest drinks group in the world, is looking in pretty good shape operationally. Thank you, Vincent.